Hi everybody, welcome to this month's tax tips. This month we're going to talk about a little known stamp duty exemption that will allow landlords to avoid having to pay stamp duty on purchasing subsequent properties. Now, we know, I'm sure everybody knows that at the moment, if you already own your own home or you already own a buy-to-let portfolio, as a landlord, you are liable to the additional 3% stamp duty levy on any properties that you purchase. That applies whether you buy them in your sole name or through a limited company, and of course adds what can be a fairly significant additional cost to the purchasing of additional properties for your investment portfolio. So I wanted to bring you this month and how to actually avoid stamp duty on purchasing additional properties. So this exclusion is perfectly legal. It is an exemption set out in law in the Finance Act 2003, and it applies to any property purchase where the property is purchased from the executors or personal representatives of a deceased individual. If you are a business that undertakes a trade in buying such properties, then you will qualify for the relief as long as you meet several conditions which I've listed out on the screen below. Now, first of all, I just wanted to address the point that you need to be in the business of buying properties from executors or personal representatives. The question that immediately arises is, well, if I buy the first one, how do I prove that I'm in business? Well, it's going to be a retrospective definition, in that if you buy one and then buy subsequent properties, by definition, your first one is part of the business, and therefore you should qualify for the relief. There are some other conditions that you need to meet in buying the properties in order to qualify for this stamp duty exclusion. As you can see on the screen, the first one is that the individual who died must have occupied the property that you're buying as their only or main residence at some point in the period of 2 years ending up until the point of their death. So if the deceased was renting the property out in the 2 years up until the point of death, then it won't qualify for this relief. But if they were living there, which they usually are, or usually were, in a period up to 2 years, which allows for them perhaps to have gone into care, then the property sale will qualify for this relief. Further conditions: if you're buying the property, often there's going to be some refurbishment costs that go alongside the purchase and then subsequent reletting of the property. Then there is a restriction on the amount you can spend through these on your refurbishments to qualify for this relief. The maximum you can spend is £10,000 or 5% of the price paid for the property, subject to a maximum of £20,000, whichever is greater. That should allow, I think, in my experience, most landlords to qualify. I don't see many landlords spending much more than £10,000 on a refurbishment. Often there is, it depends obviously on the property that you're buying. There can be scope, obviously, spend a great deal more than £10,000. So will obviously be important that you do your due diligence on the properties before you buy them if you're looking to qualify for this relief, and have any quotes lined up in order to deal with any renovations that might be required prior to you letting the property out. Further conditions that you need to make sure you comply with: if the property is being purchased through a limited company, then you mustn't be permitting any of your directors or employees to occupy the property in the future, which, to be fair, I don't think many landlords will have an issue with that. And finally, the area of land that you're buying mustn't exceed what's called the permitted area, which is half a hectare. Again, I don't think many landlords are looking to buy properties in excess of half a hectare to add to their residential property portfolios. So again, that shouldn't be a condition that causes too much of concern. So, like I say, if you meet all of those conditions and buying a property, then no stamp duty to pay on the purchase of these properties. So quite a significant saving for you, and one that would probably go actually towards the cost of the refurbishment, effectively paying for itself as you look to let it out. So finding properties of this nature might be quite a good way of increasing your profits on your rental portfolio, as HMRC often look to attack these through the changes that they've made to the tax system over the last few years, this one actually might work in your favour. Okay, this one's quick tax tip relates to the budget. Today, the day I'm recording this, is Thursday the 28th. We had the budget yesterday, and thankfully the Chancellor managed to resist the urge to make any significant changes to any of the main taxes: income tax, corporation tax, national insurance. We've heard all the announcements already, and there was nothing new in the budget. So we can cover the budget with a quick tax tip, which relates back to last month's Tax TV. Last month, we talked about the annual investment allowance and the fact that the ability to spend up to £1 million a year and qualify for capital allowances through the annual investment allowance was going to end on the 31st of December, and that the limit for spending was going to fall to £250,000. Well, the Chancellor must have watched Ascentis TV because he's extended the deadline for this £1 million limit to drop. And we now have until 31st of March 2023 to spend £1 million a year on plant and machinery and equipment, after which, as things stand at present, that's when the limit will now fall back down to £250,000. So the requirement to get your spending done before the end of this year no longer exists. You've got until 31st of March 2023 to plan your significant plant and machinery expenditure.